Greetings. Wanted to do a video that discusses how to use put debit spreads to hedge uh, your high yield positions, or really any position you might have in the market, but specifically for high yield investors. This is something that I do, and I think it's timely, or maybe late, given that we've had a little bit of a pullback in the markets in the last couple of weeks. So, for our purposes here, I'm going to assume that you have a basic understanding of how stock options work. Um, the internet is um, replete with all kinds of channels and videos about how stock options work. I'm a fan, by the way, of um, SMB Capital, their YouTube channel. Um, they're a proprietary trading desk out of New York City. They do some really good videos and all kinds of different option strategies and things like that. But for our purposes here, I'm going to assume you understand the basics between calls and puts, buying and selling each of those. So the main reason I'm talking about uh, debit spreads instead of just buying a put, an out of the money put down below where the market is mostly just to offset cost. Um, Buying a put can be expensive. So in this example here at Option Strat that I've got pulled up, in this case, we're using the Qs as our example here. If you were just to buy this 445 put, which would currently be about 11% out of the money at a February 28th expiration date. So let's look at that. That's $5.52. So so you're going to pay $552 for that contract, right? Let's say you've got 100 shares of Roundhill's QDTE that's throwing off, a good yield for you. This would be more than you're going to make in dividends off of that between now and then. But we can offset it almost, a large chunk of that cost here, $4.83, by selling below that point. So your net cost on this particular position is $69. And we'll click over to the graph section here so you can see the impact of that, right? You buy this spread for $69. And if the market stays above, really right around this 444, 45, 444, 445 range, if it stays above that, you bought a hedge, you bought an insurance policy basically that you did not have to use. However, between now and then, we get a pullback in the Qs in this particular case of more than about 11%. You can see we very quickly end up in this profit zone. We'll expand this out a little bit. And that profit zone extends. I mean, if the Qs went all the way down to zero, you would still have this little bit of profit on this trade, which could then partially, at least, offset any loss in value of your core positions. A hedge doesn't necessarily have to offset every dollar for dollar drop in value in your core positions. The hedge is to help soften the impact a little bit. Or maybe you just want to hedge enough to where you're insured against a margin call, right? Maybe you've got a high amount of margin on an account. You're compounding your returns very quickly, trying to grow. Maybe it's a small account. This is a way to have a hedge that doesn't cost a whole lot of money and keeps you from blowing up your account if the market has a correction. And we know these corrections happen, right? A handful of times a year, you're going to get a 5% or more correction in the market. Once a year or more, you might get a 10% or more correction. And we know there are more significant events that do happen. We had a significant correction event just first week of August of this year that spooked a lot of people when we had the carry trade unwinding. Now, in this particular example, I've got these set at February 28th, so $69. You're going to buy yourself some protection all the way out to that time period. You can go shorter, right? We can go to December 27th, so we'll cut 2 months off of that, and we're a little under half the cost now. So you're looking at $32 for that hedge. But let's go back out to the 28th for a second. Now, this particular example, we're protecting down, up starting around about 11% drop in the market. And I'm going to go to the table view here just so you can see the impact of this. Now, this max profit, the full amount of that's not going to be realized unless you get a significant drop below the long strike at 445 in this example, unless you're really close to expiration, so that the extrinsic value, the time value, has eroded out of these option positions. If we wanted to hedge against maybe a larger drop, the cost comes down quite a bit. So let's say we, instead of a 10 or 11%, 14% drop, we want to start hedging around about a 20% drop, in this case in the Qs. Well, so now we're looking at really needing to be down probably closer to about 400. And you could do a 5 wide spread here for $30. I mean, it's just really not very much. If you have 100 shares of, let's say, Roundhill's QDTE, you're throwing off on average $30 a week in distributions from that. So you're going to take, basically going all the way out to the end of February, 1 week's worth of distributions to hedge that position against a significant downside event. And again, if we shorten this time frame by a couple of months, we'll go again, expiration day, third Friday in December. You can see now we're down to $6. So basically, let's see, today's the 17th. So basically, for a month's worth of protection, you could pay $6. And if we get a catastrophic downside event over the next month, you would be hedged against that. And if you're at E-Trade, this is what that order would look like. Basically, you would be buying. So you'd have a long option at the higher strike, in this case, the 445, and going to pay somewhere around $5.50 for that. And then you're going to sell or go short the option. In this example, again, we're 5 points below. It could be 10 points. Again, this is just for example purposes. And that's going to trade around $4.90 as of close of business on Friday. So you can see here, about, in this case here, looking at their numbers on E-Trade, this was about a $69 trade for that hedge. If we look at Robinhood, again, very similar. They're showing $63. Again, this is just depending on whether they're whether you're using the bid or the ask or some combination thereof on these trades. But you're looking at between $60 and $70 in this case for that hedge. If you're at Schwab and you have access to Thinkorswim, this is what this would look like. We're going to go to the February 28th expiration for the example used here. Go over to the put side, and you would buy the 445, sell the 440. And we can see here that's got in this case, it's 56 on here. So again, we're in the neighborhood of about $60 to $70 for this position. And that is just way better than trying to hedge a much larger gap and spending $500 or more on just buying a put. Now, certainly, you go further out of the money. We go all the way down. We'll go down to 400 because that gets us close to about a 20% drop. Even then, though, you're still going to be spending, if you're just buying the put without shorting something to offset the cost, selling a put to offset the cost, you're still looking at a couple $100s. So I just think doing the spreads to provide some offset just makes a lot more sense. And the chances of the market dropping 10% are obviously much greater than if it dropping 20 or 25% in a short period of time. And as the market moves, you can roll these positions to account for that. Unless the market drops, this position is going to expire worthless unless you roll it. So you could get, you could buy this position, and in 30, 45 days, couple of months, you could close this out for for any remaining value that's in it, and then roll forward another another month, couple of months, or however long you want to extend that protection. And and the benefit of that is that options, the theta decay in options accelerates as you get closer to expiration, and so if you're rolling these positions 45 or 60 days out, you're kind of saving yourself the loss of all that extrinsic value as you approach expiration. Again, this is just one strategy that I'm using to provide at least a little bit of hedging in some of my accounts. It's just much more capital cost effective doing the spreads than it is to just buy the puts. And certainly there's all kinds of different combinations. But the great thing about this is, again, I mentioned Roundhill's QDTE. Let's say you've got a large position in XDTE or SPY-T or SPY-I. Some of the you could do this. You could do the same thing. You could do the same thing on the S&P 500. We'll go back to option strat. I very much like the option strat tool. I have from time to time been a subscriber to option strat. It's not a perfect tool. There's some things I do wish it did a little bit differently, but super helpful. We'll go to the SPY here, and let's see, SPY's at 586. So if we want to hedge that, let's say you wanted to put a hedge in against a 10% drop in the market. So let's just call it, let's say it's 50, almost 59. Let's call it 60 points. So we're going to want to be down around 525. So we're going to move this all the way down. Let's see here. We're going to slide that way out. We're going to move this all the way down to 525. And again, maybe you want a 5-point spread, maybe. And let's we'll bump the range up here so we can see what happens as we get a significant, if we were to get a significant drop. So now and because the implied volatility is lower on the S&P 500 than it is in the Qs, so now you've got a $40 cost for this position, and you can see that if at any time between now and the expiration date for that position, we were to get a significant drop in the market, you can see the value start to go up on the positions here. And again, in the short term, the market just has to drop. If it were to drop relatively soon, the value of this position is still going to go up. Again, providing a little bit of a hedge. Maximum value, though, is not going to be realized unless you get all the way towards expiration, or we'll expand this out even more, or you get, in this case, a much more significant drop in the market. We could do the same thing on the Russell. So you can go to the Russell, trading at around 229. So if we were going to hedge, let's say 10% below that. We want to be down around 205, 206. So we just slide that down. Again, here we see the volatility is a little higher than it is on the S&P. This is a 60. This position costs $62. So those examples are looking at the indexes. You can obviously do this with any underlying that options trade on. So let's say you've got a large position in Yield Max's Tesla, and you're worried about a big market pullback, and you just want to hedge against that. You could certainly go in and purchase a spread on Tesla. Now, the implied volatility is almost 60% here. So these are expensive options. You're looking at, so to buy that 260 put is $12. You're making $9.30 selling the 110 points lower in this case. That's a $265 debit. So you have to play around with this a little bit, figure out what might make sense, what might not. So again, that's just one thought with a couple examples on a way to cost effectively hedge at least a little bit of downside in the market. I didn't do an exhaustive analysis of what makes sense and how many times a year things happen and all that kinds of stuff. Just this is something for your own risk tolerance you'd have to figure out. I also used a pretty narrow spread on the downside with the 5-point gap between the long and the short options. That may not be enough cushion depending on someone's account situation. So again, something you can play around with, figure out what makes sense and maybe what doesn't. I do know this, as we all do, markets go up, markets go down. Sometimes they go up or down in violent movements. More often than not, if it's a violent movement, the movement is down, but sometimes markets crash upwards too, despite conventional wisdom. If you've got a significant movement in the market and you're invested in high yield funds and the underlying value of that fund goes down, that's not really traditional destructive NAV erosion. That's just a loss of value in the underlying. And we know those things happen. If you're heavily margined, in my opinion, it just makes a lot of sense to have some kind of hedge on there because you don't want to have a big market correction and then get hit with a margin call or blown up your account, had to liquidate things at a loss. We're all trying to maximize yields, but take a piece of it and protect yourself. So anyway, with that, I hope you are having a fantastic day and week, and best wishes for success. Take care.